Hello Propenomix people, and welcome to the Sunday supplement from the 31st of March 2024. And this week I've called it Happy Easter, but with a question mark. So, as you'll know, I like to start with a quote, and this week's is this: "Spring adds new life and new joy to all that is." And that's from Jessica Harrelson, the author. So before we begin, I want to give thanks to Adam Vickers and Karen Stanbridge for having me to the Reading Property Meet this week. For those who've never checked it out before, it's a very friendly room with a great bunch of people, professionals and support, and also has an online iteration. Reading and the surrounds is a definite hotspot for growth on my hit list for the next decade plus, and I'd highly recommend it to those thinking about new investment areas. Thanks also to those who booked onto our upcoming property business workshop, which is happening next month. Rod Turner and I will be covering due diligence, mergers and acquisitions and joint ventures, with some real-life case studies of deals we've done, the good, the bad and the ugly. The tickets to the workshop are at the link bit.ly/PBWTWO. The date is Wednesday the 24th of April, and if you haven't booked your ticket yet, please grab one of the last remaining ones. So welcome to the supplement proper, everyone. A short week thanks to Easter, and it felt quieter as Easter holidays kicked in for many. We managed a handful of completions, with the one that was screaming the loudest turning out to be screaming loudly because their solicitors wanted to knock off early. That one didn't work out so well. Macro had a quiet week too, and finding 4 pieces of subject matter is relatively easy, because there are really only 4 things to discuss this week: the CBI distributive trades, GDP growth rates, business investment, and the bond and swap yields, naturally. That gives us some rare room and time for reflection, which is great. We've got a Zoopla report to look over, which will be worthwhile. The Bank of England have also published their quarterly financial policy summary, which I'd like to draw a few things out of. At the same time, I'd also like to cover the ONS's response to rental prices, since their measurement of the rental sector has been late to the party comparatively, and also not the best in terms of methodology. Exciting stuff for a number freak such as myself. Onwards then. CBI distributive trades. I've mentioned before, in passing, but basically an index measuring retail sales compared to the previous year. A massive +2 print this month. That's the first positive for 11 months, above expectations, although mostly explained by Easter being a bit earlier this year. The expectation is that we will decline again in April, as Easter 2023 drops out of the figures, and an April with no Easter comes into the figures. Retailers reduced orders to suppliers again this month and expect to do the same in April. The sector continues to be somewhat beleaguered, but I understand it thus: massive boom with 5 to 10 years of growth in 2020-2021 as the lockdowns ruled the waves, all achieved via online sales of course, and then a correction or a deflation of that bubble. We're not quite back to business as usual, although we must be very close. Inflation hasn't helped the sector at all either, primarily because of their disproportionate use of minimum wage labour. GDP. This is the first part of the revision. For those who don't know, the ONS gets multiple bites of the cherry in changing the figures up to 2 years. No revision to Q4's figures for 2023 just yet, so the recession that never was remains in the history books for now. We're now safely at the end of Q1, and it would be a big surprise if we didn't see economic growth in Q1, especially as the earlier Easter should help some figures, but the bank holiday won't help. It might be quite close, but I'm going up 0.4% for Q1 2024. We look in much better shape than in 2023, although progress might be quite slow. Business investment then, a move to growth quarter on quarter for Q4 2023. That's good news. Q3 was very limp indeed as rates peaked and businesses instead started to hoard cash, which was sensible. That sees a 2.8% increase year on year, and Jeremy Hunt has thrown every tax incentive he can at encouraging business investment. However, I'm buoyed by Rachel Reeves's noises around private sector investment. We desperately need it. It will be investment on the never never, but it's better than just servicing debt for the rest of our lives. We just need projects with positive net present value. Easy, right? Not at the public sector level, no. So what we need are huge margins and strong sensitivity analysis. Politics will get in the way though, of course, sadly. That leaves the pet project, the ever-present, the bond and swaps market. Only 4 trading days, and I'm delighted to report as dull as ditch water. the dullest week for some time. Needle only moved between 3.8 on the 5-year gilt where it opened and 3.89 all week. We closed at 3.832, suggesting very slightly that we move up again before we move down, slowly. The swaps, 3.77 on Wednesday's close on the 5-year SONIA. The mortgage market money, without any margin or operational costs applied, remember, which is still trading below the market, which closed at 3.82 on the 5-year on Wednesday. Supply of money still exceeds demand, and it remains to be the case that rates need to get a chunk cheaper before demand for money exceeds supply again, or the property market needs to hot up. But it will only hot up if interest rates are lowered, unless there is an external incentive, such as a stamp duty holiday, which looks unlikely. Nice and easy. Steady. Boring. I love that. Give me sideways, steady and boring all day. Those markets are absolutely the best to trade in, whilst others are stuck scratching their heads and the retail investors are out on the sidelines, stuck into crypto or whatever. On to Zoopla's report then. Those regulars will know I've become a fan of Richard Donnell and the rental market report that comes out monthly. Richard's official title now is Exec Director at Houseful. Presumably the holding company has gone through a rebrand. But their numbers are far more accurate than some of the other data that's knocking around in real time, as you would expect, particularly on rentals because they have significant market penetration. Their headline stats: 7.8% annual rental inflation for new lets. Home lets say 7.4, so we're in the right region here. 7.8 is the lowest for 2 years. 20% down year on year in rental demand. That's huge. Rental demand was screaming last year, and this is a huge drop. Expect that to temper prices somewhat. Richard frames it as pandemic factors easing and the labour market cooling. 51% of rentals now have a rent above £1,000 per month. That blew me away. And then a few deeper dive stats below the headlines. 20% more rentals available than a year ago, but still below the pre-pandemic average. Also, with the sector being so much bigger in terms of demand thanks to net migration, absolute numbers aren't really the right comparator here, in my view. London rent inflation slows to 5.3% as supply and demand imbalance converges and affordability pressures limit rent rises. However, this is March. Big pay rises coming next month for many workers, remember. And Scotland still leads the way. Not that it is stopping the anti-landlord policies from the ideologues who refuse to recognise what economics actually means. 11.6% rental growth year on year. Some notable parts of the report as well. Only a rapid expansion in supply will start to improve affordability for UK renters. Good luck with that. Structurally impossible, let's face it. We're back to 12 homes to rent per average agent, compared to 16 before the pandemic. And the market has got bigger, as I said, over these 5 years. Anecdotally, I spoke to an agent who looks after a portfolio in Scotland for us this week. They manage about 500 units, and they've currently got 2 on the market. That's right, 2 out of 500. So what's that, 0.4%? There are still 15 inquiries for each home there is to rent, which is still double the pre-pandemic numbers. In the east of England, 70% of properties for rent today are over £1,000 a month. In 2020, that was 24%. Rent is up 29% since January 2020. CPI in that time period is 22.7 for context, but RPI is not far off that figure. Construction inflation is 32.4% over the same time period. The build-to-rent sector completed units now number 90,000. These are driving rents upwards since they're in great locations with super facilities targeted at those who can afford more than £1,000 a month in rent. At the end of 2023, Zoopla recorded rent as 29.5% of gross earnings nationwide. This speaks to how much affordability headroom there still is, as 33% is the standard score, and this figure is badly weighted by London and the South East, where a larger percentage is accepted as workable. They're forecasting 29.9% by December 24, compared to the previous peak of 28.6% in December 2015, when the rental sector was at its peak, although wings had already been clipped by our dear friend Mr. Gideon, I learned economics on the job, Osborne. It takes time for that to filter through. The 10-year average is 27.8% for context. Zoopla sees rental inflation at 4 to 5% this year, and they're convinced they're on track. They're also convinced that wages will be growing at sub 4% at the end of the year, or at least they believe the forecasters that are saying that. My range is 4.5% to 5% by the end of the year, so I disagree. I think rental inflation will look more like 7% this year, but they're only talking new lets, as that's the only data they have. I'm talking all rents, and that's why we'll look at the ONS rental pricing report too. There's a couple of really useful sentences here that I'm going to replicate in their entirety with some commentary. First, a sustained expansion in available supply would drive a faster slowdown in rental inflation than we might expect. It's likely to result in rents falling in some city centre locations. This may well happen in 2024, but not on a scale that would impact the headline growth rate. So, take note of demand versus supply if you're developing or buying units in a city centre. It's a timely reminder that it is very easy for micro markets to be oversupplied, even in a time of undersupply nationwide. Then, ongoing low levels of net new investment means below average levels of rental supply are set to persist, supporting headline rental inflation. This is persisting with only £1 in every £14 of new mortgage debt being for buy-to-let, compared to about £1 in every £7 or £8 as a 10-year average. So about half the new units will be coming online compared to the 10-year average. Ex-London rents are up 9%, that's new rents. The average ex-London rent is £995 per calendar month. Quality stats and insight from Richard once more. Over to a brief segue into the Bank of England financial policy summary then. 4 key takeaways with my commentary after each one. Overall risk outlook conditions remain challenging. Global and geopolitical risks are high and have continued to increase. Couldn't agree more with this. Not sure they've increased an awful lot in Q1 2024 though, more like volatile. Bits that could have bubbled over haven't. Anyone with half a brain would be particularly careful about attacking the USA in an election year and with Donald Trump waiting in the wings. Financial markets. Asset prices are stretched. The risk of a sharp correction in a broad range of asset prices has increased. No kidding. The short sellers have given up on the market at the moment. This is one big bull run. Inflation adjustment, which is never used on the stock market ridiculously, does put things more into context, and the revenues driven from AI, more accurately from the hardware used to make AI-capable servers, are much more real than .com. However, you can't help but feel there's a correction coming, and when it does, corrections are 7 to 10 times faster than bull runs. So fingers will be on triggers. UK households and businesses have been resilient so far to the impact of higher interest rates. So far, yeah. This leaves out the bank's analysis that we are 70% plus into the impact of this hiking cycle, which still feels too high to me. And also that the cycle actually helped because a lot of the debt was at low fixed rates and a lot of the savings were floating and their returns became much more generous. UK bank resilience. The UK banking system is strong enough to support households and businesses even if the economy does worse than expected. Well, they would say this because this is their job, but there's no doubt in my mind we are doing a 10,000 times better job than we were doing before the Bank of England was independent. There's one further extract that I wanted to share from this report without commentary from me because I believe it speaks for itself. In particular, the prices of houses and commercial property, such as offices and retail premises, are falling in many countries, including in mainland China, where the property sector has been under stress for some time already. Our stress tests have shown that UK banks are strong enough to withstand any direct impact, but it could hit investor confidence more generally if it has a big impact on overseas banks, for example. You might have seen the US is struggling quite a lot more with its commercial real estate sector because it's much more leveraged, it's much bigger, it's much higher as a percentage, and there are many more large cities along the scale of London rather than our smaller, more micro cities. So let's go full circle then and round off with a look at the ONS's rebadged Price Index of Private Rents, PIPR. This is the first release of this metric. It lags only a couple of weeks, or 2.5 weeks, so it's in line with the inflation figures effectively, which is a vast improvement. This simply was not prioritised over time, and data proper only started in 2005, which sounds a bit crazy, but don't forget the buy-to-let mortgage proper only came about in 1996, and this is a public sector organisation after all. So here's the meat of the report with some commentary. Average UK private rents increased by 9% in the 12 months to February 2024. That's the provisional estimate, higher than in the 12 months to January 2024. Now, This is the record increase ever noted by the ONS, although this particular data set only goes back to 2015 anyway. Note how far it is lagging the record CPI inflation numbers of 11.1% from October 2022. It's nearly a full 18 months. That's very typical for rent inflation, and exactly why I expect it to go down less quickly than Zoopla seems to think it will. This compares interestingly to Zoopla and home lets figures, but remember these are not new lets, these are all lets. About 22% turnover each year, or 2% a month as a rough proxy. So annually, if we said new rents are up 7.5% and make up 20% of the index, that would be a contribution of 1.5%. And so the other 7.5% to get us to 9 would be coming from the 80% of existing rents, which would mean they were moving up at around 9.4% in annualised terms. Now that sounds about right to me from what I've heard and seen. In the 12 months to February 2024, average monthly rents increased to £1,276, 8.8% in England, £723, that's 9% in Wales, and £944, 10.9% in Scotland. Note, Scotland's still leading the charge on everybody's figures with their anti-landlord rhetoric and policies. I'm sure that's just a fluke, though, according to them, more like an inconvenient truth. In England, private rent inflation in the 12 months to February 2024 was highest in London, 10.6, and lowest in the North East, 5.7. Now, this is very contrary to the new lets information from Zoopla, so it must be being driven by existing rents catching up, or similar. 10.6 on those high rents already. Ouch for the tenants. Average UK house prices decreased by 0.6% in the 12 months to January 2024. That's the provisional estimate, up from a decrease of 2.2%. That's the revised estimate in the 12 months to December 2023. So the ONS figures were 0.8% outside of my range last year for pricing. I'm furious, of course, but I was a lot closer than the bearish dart throwers that inhabit the forecasting space. You can see here how dramatically that would change yields though. Here's a worked example. House worth 100k, rent of 600 a month at the end of 2022, yield 7.2%. House worth 97,800, that's reduced by 2.2%. Rent 654 per month, that's increased by the rental figure for 2023. That takes the yield to 8.02% by the end of 2023. Now that requires active asset management, of course, but that's a relative increase of 11.14% in the yields overall. That's some change in just 12 months, and will have brought some people back to the market, although those using leverage are still hamstrung by higher rates, of course. Here's another snippet that bears repeating from the report. In their February 2024 UK Residential Market Survey, the Royal Institution of Chartered Surveyors, RICS, reported rising tenant demand and, for the 19th consecutive month, declining volume of new landlord instructions. Because of this imbalance, their respondents continue to expect rents to rise over the coming months. 19 months of fewer landlord instructions on the spin for the RICS. That will take years to rectify. Rents would typically lag inflation by about 12 months or so, but 18 isn't unreasonable. So we must be close to the peak if this is not it. The road down is unlikely to be particularly fast and may well look like the climb down of CPI from its peak. But CPI was affected significantly by energy price volatility, whereas rent, outside of HMO, won't have been. So expect a relatively slow descent back to normal at some point in, 2026? You can see why I'm pricing in 25% rent increases in total over the next 5 years. With compounding, that averages out at around 4.7% per year. And I believe, actually I know, that rents are still cheaper in real terms, inflation adjusted, let alone wage adjusted, than they have been in recent years, 2016, 2005. There are other comparables too. I wouldn't be at all surprised if we kick that series off this year with 7% plus, as I've said. We have two numbers for 2024 so far, 8.6% annualised and 9% annualised. Future looking a bit brighter than 3 months ago. It probably should be. It's slow going at the moment, in fits and starts, bits and bobs. The market looks easy one week and impossible the next. Keep going, keep following up, turn up, be consistent, do what you said you were going to do. That is what gets the deals done. Tenacity, resilience, drive. There you go, an Easter egg of a pep talk. No 9 AM live this week, so I'll be back next time out in the supplement, but there'll be plenty of content on the Propenomix channel between now and then. Please subscribe if you haven't already. I've passed the magic 950 and 1,000 subs is within touching distance. Congratulations as always for getting to the end. Don't forget the Property Business Workshop on Wednesday the 24th of April. Tickets for you or anyone you know who might want one are at bit.ly/PBWTWO. Onwards, upwards, as we lurch towards Q2. Keep calm and carry on.